And I'd like to call up onto the stage the participants. Diana Guzman is Group ESG Director at Prudential. And Diana, I'm going to take this seat here, so anywhere else you want to sit will be fine. Samaila Zubairu, President and CEO of Africa Finance Corporation. Mr. Zubairu, thank you very much. His Excellency Nguyen Hoang, Ambassador, Vietnamese Ambassador to the UK. Welcome to the stage. And Philippe, Valahu, CEO of the Private Infrastructure Development Group. Welcome to the stage. Now, we are being joined, I was a bit worried about the technology there. Thank you very much to our extraordinary team and crew. And we are joined also by Dr. Mahmoud Mohieldin, who is the high-level champion of COP27. Mr. Mohieldin, well, I'm looking at you. You are presumably being filmed from there. I'm looking at you. You loom over our other participants here on the stage, so your presence is very much felt here in the room. Now, I'd like to start, if I might, Diana. Kick us off with some examples of where it is working, where money is flowing, where we are indeed, as the title of the session says, channeling green finance to emerging markets for a just transition. Give us a few examples. Give us the good news.
Thank you. Well, thank you very much, and it's a pleasure really to be here this morning. Thank you for the invitation to the City of London. As you might be aware, Prudential is a company that for 175 years has been mobilizing capital, 100 of them in Asia. And what has worked very well there is partnerships. Partnerships at the local level. Partnerships, for example, like the one that we have with PIDG Group, Garanco, where we are able to substitute some of our corporate bonds, for example, with green, so government bonds with green corporate bonds, and enable us to invest in local currency, enable us to invest in the green transition of countries, enable us to also create local green capital markets. Partnerships on the ground are extremely important, and they can take different shapes and forms. It can be public-private, private-private, but what's very, very important in our learning by mobilizing capital is that actually the regulators and the broader financial infrastructure of those countries actually have a seat at the table to then enable us to create the right enabling environment for these partnerships and this capital mobilization to reach scale. So it's very, very important to have the right partnerships on the ground, nimble, flexible, partnerships that understand both the risk and opportunities in the countries where we operate.
Can I ask you to just give us a bit more detail just on what sort of partnerships? Is it partnerships in capital provision or partnerships on the demand side to prepare projects and opportunities because the money is sitting there, that's not the problem? Which of those requires most attention? Or which one, again, we're going to do the success stories. Which of those is working best?
I think both. Both are equally necessary. But I think from Prudential standpoint, as you might be aware, we need to match our liabilities with our assets. So that means that for us, especially after the pivot from the West to Asia and Africa, we have regulatory commitments to actually keep up money invested in local markets. So what it means is that our partnerships on the ground need to pivot as well and develop in a way to fit for purpose, not only to enable us to invest in green, but as we have heard this morning, also to enable us to invest in brown to green. So capital deployment is very, very important for us, and the partnerships to enable us to move money where it's most needed is what at the moment is a key priority for us.
Okay, so Samaila, now we're hearing partnerships, everything's working fine. I'm hearing a very confident, very calm. It's all fine. We just have to do a bit more of what we're doing, perhaps, but it's all fine. Now, is that your experience? And perhaps start to move us into where we might have some roadblocks that we need to remove.
So thank you. Good morning. Thanks for this opportunity. I mean, she's right. Partnerships are important. So, for example, we're a public-private partnership between African governments, and private financial institutions, that has created Africa Finance Corporation with a focus on de-risking, infrastructure opportunities for investment. And when we were created, the amount of investment required for infrastructure was significant, but there was a dearth of projects. So our focus has always been on how to work with governments and sponsors to transform the ideas and opportunities to bankable projects. And we have done that at scale. And there are several examples of how it has worked well. There are several challenges along the path, and I'll start with how it has worked and then go on to the challenges. So for example, we partnered with the government of Gabon to build a special economic zone. That was a combination of several infrastructure assets that would enable industrialization and help them transition away from hydrocarbons to other aspects of the economy. So we have the first carbon neutral certified industrial zone in Gabon, and it produces, I would say, about 6% of the country's GDP and creates over 32,000 jobs, both direct and indirect. It has increased export earnings significantly for the country, and we have found avenues to replicate that same success in Benin Republic and in Togo. Now we're looking at Chad, DRC, Sierra Leone, and several other African countries. We also have a very good example in our renewable energy platform, where we first started with building a wind farm in Cape Verde, provides 20% of the energy requirements of the island. We've built a hydro dam in Côte d'Ivoire, still under construction, that will significantly reduce tariff. We've also currently almost completed construction of a wind farm in Djibouti that will provide almost 100% of the energy requirements of the island and put them on a path to sustainable, renewable energy in the country. On the back of that and the experience that we have, considering the significant amount of energy required for the continent, we decided we needed to do something at scale. And so we worked with our partners to acquire Lekela, which is the largest renewable energy company in Africa, with the idea of scaling, and enhancing our bargaining power, and also really negotiating and finding ways to make the inputs that are required for renewable energy in Africa. And I'll give examples. So the IEA tells us that 60% of the best solar sources in the world are in Africa. Less than 1% is built. It will not make sense to continue to import solar PVs from China into Africa. We have in Africa significant natural gas. We have silica. So it makes sense to start to look at how we can start to import that, especially because we know that shipping is a big part of one of the biggest polluters. It's actually the 6th biggest polluter globally. So to continue to import, implements while we work towards net zero will not make sense. So we currently have a program now in one of the new special economic zones that we're looking at in the Republic of Congo on how we could build photovoltaic plates there. And so we have several examples of what has worked, but the real challenge we have is that we're not able to get the capital that we need to do all the work that is required. So there is a significant mismatch between the custodians of capital and where capital needs to work. So for example, we have a pipeline of over $3 billion of projects, but we don't have the money to do it. We have several conversations, there's several pledges about capital going for renewable energy, but it's not flowing into Africa. So African countries, to meet their nationally determined contributions based on the Paris Agreement, require upward of $280 billion annually. You heard the Minister of Finance for Egypt mention that Africa needs $3 trillion, and that is between 2020 and 2030. But what is flowing into the continent now is less than $30 billion. And that's mainly from African governments themselves funding the energy transition. Now, that has to change. We have institutions that have over $100 trillion of capital under management with no allocation to Africa. So there's really no allocation to Africa. And without allocation to Africa, there will be no capital flowing into the continent. Secondly, if you look at the capital that flows into Africa, it's mainly debt. So most institutional investors have debt funds or can invest in debt instruments. None of them is investing in equity. And it's equity capital that is required to de-risk the opportunities to make the projects bankable. We hear a lot of talk about the absence of bankable projects. How will we have bankable projects if we don't make the investments to develop them? We are at the forefront of that, and we're looking for partners to work with to scale. We've recently launched an infrastructure climate resilient fund with the idea of introducing an asset class that can mobilize climate finance at scale, essentially working with a blended finance structure. But there are no takers. So we hear a lot of talk, a lot of words, but the capital is not flowing. So if we're going to be frank and open and have a productive session today, we would need to understand why is the capital not flowing when you have institutions like us that are investment grade, have a long track record, have operated profitably, clear demonstration of what works, yet there is no partnership with us for us to continue to do what we're doing. We need to understand what is required for capital to flow into Africa. What is required for even, I would say, 0.1%, not 1%, 0.1% allocation for climate finance in Africa? Those are the questions that we need to address today.
An extremely eloquent and cogent framing of the problem, because you started with some examples where it's going, the wind farms, the development zones, and then, of course, the downside, which is that it's all much, much too small. It's 2-3 orders of magnitude too small, and being largely developed, you said, through domestic finance.
Yes.
So your own capital base is mainly, do you want to say a few words about your own capital base? Where is the money coming from?
So Africa Finance Corporation was established by African states in partnership with African financial institutions. So for example, the government of Nigeria, the government of Egypt, the government of Ghana, the government of Gabon, the government of DRC, Senegal, Guinea, they are all shareholders of AFC. We have about $1.2 billion in equity capital. We have retained over $1 billion from operations over the years. So we have about $2.7 billion in capital. Because we are investment grade, we've mobilized about $7.5 billion from the debt markets, bilateral loans from development finance institutions like DEG, AFD, African Development Bank, and then the Eurobond market, where we raise bonds regularly. But the challenge is most of the capital really comes from Africa. So even when we do Eurobonds, we have African governments, we have African pension funds, we have African financial institutions as the main takers. We have investors from the US, from Europe, and from Asia, but it's not much. So there is still, I don't know how to describe it, there's still no flows into Africa. No flows.
If only we were having this conversation in a location where there was plenty of accumulated capital that could flow in your direction, so somewhere like the City of London. Now, I want to just change the focus, if I might. Ambassador, we've heard this description of the challenges in Africa. The projects are coming through, the success stories are coming through, the local capital is coming through, the international capital isn't. What is the experience in Vietnam? Does this sound familiar, or have we got a completely different set of problems? Let's get all of the issues out on the table.
Well, thank you very much. I don't want to compare Vietnam to Africa because they're very friends of us, so maybe we are a little bit different. I want to give a general context. Vietnam is 30 years ago was one of the poorest countries in the world. It's a middle-income country. GDP per capita is already 40 times higher. The GDP per capita now is nearly $4,000, 4,100, I have to say. And will be double by 2030, and will double again by 2045. And to doing that, we have to have an average economic growth by 7% per year. And from now until 2030, in order to guarantee the economic growth, we have to double our energy production. So why I talk about that? Because 70% of Vietnam emission comes from energy. So we consider the green transition has to be a transition in the energy sector. In 2021, COP26, the Prime Minister of Vietnam has committed Vietnam to a very bold and courageous commitment. It's a net zero by 2050. But of course, in order to achieve that goal, we also demand the international support, international collaboration. We consider the just transition is a key part of that to help Vietnam and other developing countries to achieve net zero target. And what is the help? What is the support? We consider the four key sectors: the investment and the technology, the expertise, and finance. And after the COP26, we have issued our national strategy for net zero, which is critical for every sector of the economy and the society to follow. And we have signed the agreement with the G7 for the JETP, the Just Energy Transition Partnership. So the JETP aim to mobilize $15.5 billion for the next 3 to 5 years as a trigger money to help Vietnam build the green energy sector. So the energy sector of Vietnam is, and then the third important document has been issued last week, is the National Energy Electricity Development Plan. We call it the PDP-8. It's critical to have the planning of all the sector of energy in Vietnam, where we incorporate our commitment in COP26, our commitment within the JETP, within this development plan. So we phasing out the coal-fired plants. We increase significantly projects in renewables, particularly in onshore and offshore wind. And we convert the coal-fired plants into LNG. So the amount for investment of this energy sector, we calculate will be around $135 billion until now to 2030. And will be 400 to 500 billion from 2030 to 2050. So here is the business opportunity. But our principle is we look for internal domestic resources as principle for our development. Meanwhile, the external resources will create breakthrough and help to achieve higher targets if we need to go higher or acceleration on some of the targets. So in doing so, we know that in attracting investment and attracting green financing and international support, the government is proactively and actively promulgating new law, legislation to facilitate and create the framework, the legal framework to cut red tape and to give the opportunity for investment and finance to flow into the market. I know Vietnam has to, this is easy to say, it's easy to say. But in this process, we see the role played by the City of London is important. And also the UK. I'm the ambassador to the UK, so I always emphasize how the UK can be critical in helping Vietnam in this energy transition, in just transition partnership, where you have the expertise, you have the technology, and you have the finance and the financial markets. So we acted working with the UK government in building some of the key projects. And within that, the City of London is playing a role. For example, the City of London is advising the government of Vietnam in building the next international financial center, where we see green finance and inclusivity, resilience, and this kind of partnership is critical. So I think it's all on the table. I am very optimistic by nature, but I think we can achieve that.
Very interesting, because you've put a different emphasis on the importance, and possibly because there's different availability of the local risk capital, the equity capital. So quite a different picture from the situation in Africa, where it's really missing. Is that a fair summary in a sense? Either of our last two.
Well, actually, maybe I'm not the expert in finance here. I'm the ambassador.
Okay.
So I'm not adventuring in the very uncharted territory for me. But this is a very important thing. I think in doing all those things, political determination.
Right.
So because I think the nature of the person into that. Because if everything go according to financial calculation, everybody will be successful. But it's not. I think at the end of the day, it has to be person. Okay. And the person in our strategy is in the center of the whole strategy. If you want to deliver, you need person. You have to invest in person. So Vietnam, I think, we're very confident in our process, because we have this very person capital.
Okay, so there's a very, very strong signal from government, and then the personal commitments of the principals clearly playing a huge role. Philippe, I could see you nodding along with many of the comments of our first three participants. You are not the ambassador, you are a financial practitioner. Do you want to start? How is it that you address these problems at your infrastructure group, your private infrastructure group?
I think I'll pick up on some of the comments made by my friend at AFC, because he makes some very powerful points that echo the ones we make on a daily basis, I think. So let me start with success, but then to dampen the atmosphere, talk about the reality, as my friend has done here. If you look at the work we've done in Nigeria, working with AFC, working with the Nigerian Sovereign Investment Authority, to set up a credit enhancement facility, rated AAA in the local market, set up 5 years ago to issue credit enhancement on domestic bond issuance in Naira to finance infrastructure assets. In a market that before then had no pension funds or insurance companies investing in the infrastructure asset class. Today, you have over 19 or 20 pension funds and a number of insurance companies investing in this asset class. 5 years ago, they were asking for 100% credit guarantee. Today, some of the bonds are being issued with 20, 30% credit guarantees. And you can imagine what that's done to pricing on bonds as well. So you're allowing domestic capital to flow, which is the point that was made by my colleague here. You're deepening the capital markets and the pool of available savings to invest in the infrastructure asset class. And then the next step is obviously creating that secondary market for those bonds that are being issued. So that's the good news. And we've done the same thing in Pakistan. And I was talking to His Excellency, the ambassador, earlier. We're looking to do the same thing in Vietnam on the back of a green bond that we credit enhanced last year, which was the first green bond in Vietnam with EVN Finance, which it will use to fund green infrastructure in Vietnam. And the bonds are funded by pension funds and insurance companies in the country. But that all sounds rosy. But then, as my colleague said, what is the CEO of InfraCredit's main issue today? And we are 30% equity investors, so we provide about 100 million of equity. And the ability to leverage close to $1 billion. So it's powerful as a tool. But if you speak to the CEO, his number one problem today is bankable projects. So he, like me, I'm sure like my colleague, get a bit frustrated when we keep talking about the trillions in pension funds that need to move to developing countries. It's not going to happen. And I hope today we're a little more realistic about what can and cannot happen. It's not going to happen until such time as we can also address the pipeline of bankable transactions. And that goes back to the point made about equity and participants in that space.
This is really interesting for me because the model that's emerging here is not the simple model of here are the trillions are in the developed world, capital markets, the capital formation, hundreds of trillions, and they need to be over there. And let's just figure out how to move those over there. What you're saying is actually a number of things have to happen at once. Is that?
I'm sure there are pension funds in the audience, and they will tell you better than I can. They're looking for what? Ticket size? Yep. They're looking for risk mitigation products. They're looking for diversification, geographic sector, etc. That can be put together. But there has to be a sense of urgency in all of us who work in the space. You have a fragmented aid space today, clear for all to see, and still no realization that instead of people trying to replicate proven vehicles, invest in the proven vehicles. And if we don't have a call to arms and a call to collaboration in a way that's not been done before, you're not going to see that flow.
I would like to bring in Mahmoud Mohieldin, who's the high-level champion for COP27. You've been listening very attentively there, Mahmoud. Would you like to reflect on what you've heard so far in the context of COP28 and how some of these issues of simultaneously growing local capital markets, because we've heard that's vital, developing the project flow, because we've heard that's vital, and also then bringing in, maybe de-risking, maybe blending, but bringing in the finance, the trillions, because we're talking scale, delivery, remember, bringing that in from where that capital currently resides. Are there any particular ways that you're looking to work on that within the context of COP28?
Much in conundrum, with a great deal of confusion about the priorities of developing economies. The famous $100 billion that was pledged in 2009 with the name of pledging the private sector was offered without adequate consultation with the developing economies, without putting them in a developing country's context. And that's why I like very much what His Excellency, the Ambassador of Vietnam, had to say, because he started us off by talking about inclusive growth, 7%, with sustainability and long-term perspective. This is the way that developing economies need to see climate finance as part of development finance. Energy, if about mitigation, adaptation, which is outlined in the Sharm el-Sheikh adaptation agenda in 5 areas of work: in water, systems, food security, again, this is very much on the of sustainable development. Then we see more offers, not just the 100 billion. I think the issue of the JETP of the G7 had been offered. Nice initiative, including the promise to South Africa, Vietnam, Asia, and other countries coming. But it would be more practical if we see it coming towards the hard-to-abate sectors, not just dealing with coal and fossil fuel, but basically through decarbonization in the cement sector, in steel and shipment, because there are more in this sector, especially for African countries. So, and let me deal very quickly with some concern. Remain so far that climate finance is very much development finance, more aspirational than practical. Actually, if you heard the billions to trillions that came back in 2015, it came from my office when I was at the World Bank. I was telling my colleagues, this is very much aspirational, it's going to haunt us, requires environment for leveraging, which is not there. So instead of billions to trillions, we're seeing billions to millions in many countries. That needs to, it cannot go on like this. The other thing is basically what you see in COP27 and answering your question in COP28, both being held in countries of the South, last year in Sharm el-Sheikh and this year in Dubai, in the United Arab Emirates. So you see this emphasis on implementation and solutions. People do not like to see more pledges or more. They need practical approach. And what is better practical approach in answering a simple question? Does countries in the South, developing economies, have pipeline of projects? Those who say there is no pipeline of projects wrong by working with 120 countries during 6 months in COP27 with the regional economic commissions of the UN, with BCG helping us, with GFANs involved with us, and we have a compendium of projects available and a report called From Assets to Flows, basically showing some exemplary projects, 120 of them worth $118 billion as examples of what could be done if we are serious. But for that to be happening, it's not just a project. All of these projects have been from the supply side, owned fully by governments. But we need the following. First, we need quality projects. And actually, all of these projects that I mentioned, the 120 plus, have been through this filter. The second is the business environment, including governance and rule of law, because there are limits to de-risking and trying to have some sort of credit enhancement if the rule of law is not helping whatever we provide of credit enhancement mechanisms or de-risking may not work. And many countries are aware of that, and they are trying to fix the business environment while we are fixing the cases for some bankable investable projects. Then I'm saying it's not just bankable projects, but I'm saying investable projects, because as mentioned earlier by AFC, that what we are suffering from today, not just in Africa, but developing economies, that the majority of projects are based on debt instruments. We don't need more debt, and people who are bragging about leveraging, am I going to leverage debt with more debt? Optimal mix, and I'm happy to see the reference to some of the leading investment finance houses, including the one participating in this panel, mentioning equity participation, not just limiting finance to debt instrument, because already countries of the in one of three categories. Either they have a debt challenge or a debt crisis or a debt catastrophe. So I cannot really solve climate finance crisis be stopped, and we need more equity participation, but we need more partnerships and more de-risking for that. And an additional point is not just finance, it's technology. We are a world of artificial intelligence, digitalization, and I think we can really be aided very much by and technology at scale helped us to reduce the cost of obtaining solar and wind farms, especially solar, by more than 90% during the last few years. And then this gets me into the role of the multilateral development banks, because those who are in the audience today may not be able to do in countries in the frontier unless there is some sort of decent partnership from the multilateral. And seriously, they need to get their act together, the IFIs, all the multilateral development banks. They need to stop in this kind of false dichotomies. Is it a global public good, or is it a country platform that we need to work on? It's the same thing. Climate is a global problem. To solve it, you need to get your act together in a local environment. Is it climate finance or development finance? No, for God's sake, it's the same, but you need to articulate policies together. Do we need better or bigger development finance institution? We need both. So I think we need to really to act fast, because we are wasting time and we're not doing enough in this area. And we need the MDB, especially that there are many summits, as you know, coming this year after this in June summit in France, another one in Kenya, and then we have 3 summits on climate, sustainability, and financial impact, all before COP28. And if I may end with something here, that we need to have adequate impact assessment of what we are doing based on regulatory structure and better understanding of ESG. This is a very big debate happening today, and we need a better criteria as reference for ESG finance, because everybody has her or his own criteria. This needs to stop. We need, as we are more formal and we know better when we talk about BIS rules or in, IFRA rules or accounting standards or auditing standards. But when it comes to ESG, it's very much all over the place, and this needs to stop. And perhaps a good starting point is the operationalization of the recommendations of the high expert group that was convened by the Secretary General of the UN, and the UNFCCC is working hard now, is trying to put some sort of standards to minimize greenwashing. Over to you. And I said at the beginning, sorry, I said it shouldn't and it cannot go on like this, but we know from the past, it's basically the answer to this line. It could be, that's what you think. This is from the famous Waiting for Godot. But this really, we cannot really go on like this, claiming that we have the money, we have the asset, but we don't have the projects. Actually, much more better work between the public and the private sector should be done, and there is no better than the City of London and its very able finance institutions to help us providing solutions when solutions are very much needed today than ever before. Over to you.
Thank you very much, Your Excellency. A very rich intervention, they all have been, but that one in particular has opened up a number of the conversations that we will be hearing from, we'll be examining today. The point about restructuring or rethinking some of the IFIs, we're going to be hearing from PM Mia Motley. The conversation about ESG and what we measure must be real. And the whole thesis of today is delivery. We cannot continue the way that things have been. We do need a few orders of magnitude gear change. Now, what I'm going to do, we're not running behind, I won't say that, but we have to be very careful not to get behind. So I'm not going to take, if it's okay with everybody, questions or observations from the floor. We're going to miss that. These topics we've opened up on this panel will be recurring. We will be diving in during the day, and you will have a chance to hear, to share your own views and to ask questions, and obviously to find these participants in the audience at the various breaks. So what I'd like to do, if I could, is to close with a closing thought, and it's going to have to be quite a succinct closing thought from each of our participants, really around, are you optimistic? I mean, do you think we can do this, right? I mean, we have to be, I said we needed to also to be brutally honest. Are we going to, we've kept 1.5 alive, are we going to be getting things on track to deliver 1.5? Or do we have to accept that, let's shoot for 2 and deliver 2 degrees, and that will have to do because that's all we can do. Let's see. So optimistic or pessimistic? Diana, as always, I'm going to start with you.
Thank you. I'm optimistic, but I'm also realistic. And that's because we operate in emerging markets, in developing economies. And I would like to take a little bit of a step back, if I may, and I know you're crunching on time. But one message that I really want to deliver is the following. We need to double down on green, absolutely, and move capital to where it's needed. But as an asset owner that invests long-term in local currency in some of these markets, for us, what is important as well is how we're going to transition brown to green, because that is pivotal for the just and inclusive transition.
Okay.
And now, you asked me before everything was positive, and if I was, I'm going to tell you what is needed in order to get there. Clear action points. One is we need a common definition, a market-accepted definition on what is transition finance. And how does this play out in emerging and developing economies? and not even go into the detail of how industry pathways, transition pathways, we play it out in Nigeria, in Egypt, in Indonesia, in Vietnam. That is very important for us as investors, long-term investors, because we want to be seeing, we want to be more active mobilizing capital, not only debt, but equity as well. But we also need to be aware of greenwashing or transition washing. So I know we're looking for the holy grail, but really it's as important to take a step back and say, how are we going to make sure that we're transitioning, take consideration the local context and emerging markets, but that we keep that pace to get to 2050. And therefore, where is our money most needed? And therefore, that will help accelerate financing.
Okay.
So I'm positive, but I'm realistic. There's a little work to do.
Okay, and you've touched on, again, a topic we're going to be opening up today around greenwashing, around these metrics. I am going to now ask people to be extremely fast because we are technically now out of time. But I still want to give you the chance to respond on optimistic or pessimistic in as few words, I'm afraid, as possible. Samaila.
So optimistic, and I'm hoping that we can be pragmatic at the same time. By pragmatic, I mean we have to change how we're looking at things. We have to understand that what we're doing now is not working. And if we want to achieve net zero, we must change how we're doing things. We must look for ways to partner with people that are actually working on the ground and are delivering the projects. We shouldn't be trying to create parallel structures. Let's work with what works.
Very good. Ambassador?
Well, actually, I'm very optimistic. I said at the very beginning that I'm very optimistic by nature, but optimistic, reasonable, because, well, the response to climate change, the response to green transition comes from the people.
Okay.
It is the demand from the people. It's not top-down. So I think it's because of the people, and Vietnam has this policy based on people-centered. So I think with that, we will be succeeding.
Philippe, close the discussion with your final remarks.
Positive, I could speak for 10 minutes, but I will say one thing. We obsess, as AFC does, on localization of solutions.
Okay.
As I mentioned earlier, I think by doing so, we can show the way to others how to come. Without that.
And a strong theme that has come across has been this, you call it localization. It is shifting from pushing the piece of string that is global finance to pulling it into the solutions that are being created, the projects, the pipeline that is being created locally. But we need to do we need to kind of push the string and pull the string at once. I think that's what we're seeing here. So I like to...
And perhaps ban the word pledge.
And ban the word pledge. Well, we've heard that already from the Lord Mayor kicking us off. So I would like everybody, please, thank our fantastic panel, including our virtual participant, for a fantastic conversation.